Welcome to Yahoo Finance Live. It's Thursday, January 26th. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action. You're looking at gains once again in the Dow, with the Dow up just about 127 points as we kick off the final hour of trading. Investors really digesting that better than expected GDP print that we got this morning. Also weighing that against some of those mixed earning reports that we've gotten over the last 24 hours or so. So you look at gains for the Dow, the Nasdaq Composite moving to the upside, up just over 1%. You're looking at the S&P up nearly 1%, adding 31 here, up 0.8%. Taking a look at the Philly Semiconductor Index, once again moving to the upside, regaining some of that momentum that it had lost for a day or two, now up just about 1%. Taking a look at the bond market, 10-year yield moving to the upside as well, up just about 3 basis points to 3.49. Taking a look at some of those individual movers, but first let's take a look at the sector action here. Earnings, really a massive story here in today's intraday moves. You're looking at energy up just about 2.5%, consumer discretionary, the second top performer here, lagging behind. You're really seeing healthcare and consumer staples being left in the dust in today's trading action. Talking about some of the biggest gainers here, let's talk about Tesla. That stock up just about 9.5%. The company beating on both the top and bottom lines. Revenue was a record for its most recent quarter. Also, a lot of the optimistic commentary coming out of the earnings call last night from CEO Elon Musk, very bullish about demand going forward. That is pushing that stock up just about 9.5% today. Taking a look at some of those energy names, we've got some news out from Chevron yesterday. That's pushing the stock up just about 4% here. Chevron announcing $75 billion share repurchase program. So you're seeing a number of the energy stocks move to the upside here. Also, I'm going to take a look at some of the meme plays, and more specifically, take a look at Bed Bath & Beyond, and taking a look at the worst performer within the group today. You're looking at shares off just about nearly 27% right now. This drop coming in just the last 10 minutes or so, happening after the company filed a 10Q. Once again, reiterating the warning that we have already heard about in the past, that they could be forced to file for bankruptcy. So that, of course, putting some pressure on that name today, Dave, with that stock still above $2 a share.
Such a shocker. You mentioned semiconductors. We'll get Intel earnings after the bell. We'll break those down. President Biden not too impressed by Chevron's buyback. Very critical of them. Wants them to instead increase production. That'll go back and forth.
Yeah, sticking to what he's been saying for a long time. Very critical of the large oil companies.
Shauna, thanks. Let's get you up to speed on housing now. Mortgage rates falling for a third straight week. Rates down slightly to 6.13% on the 30-year fixed. And new data reveals home buyer affordability is improving. Mortgage application payments falling 3% in December, according to the Mortgage Bankers Association. So good news, yes, mortgage rates continue to fall. Some predict that the worst is behind us in terms of the housing market. I think that is fantastic. I do think mortgage rates, Shauna, are beginning to flatten out, though, because the reductions are shrinking. I thought we might land in the mid-5s. I don't think so anymore. I think we're still going to be north of 6. And what do you think? Is that enough to thaw out this market?
You know, you're starting to see some of that activity come back, but like you're saying, it's still above 6%. I don't know if that's going to be enough to get the majority of the buyers that have been on the sidelines for the last couple of months to get them off the sidelines. And remember, the Fed is still raising rates. We've got another Fed meeting next week, and next week investors are expecting another 25 basis point hike. So as long as that continues, or they keep rates at those elevated levels, you got to question whether or not we really will see significant improvement in housing.
And we should remind you, rates don't necessarily rise and fall with Fed moves, but they do tend to similarly shadow that later on. And the bottom line is here, most people are locked into a mortgage somewhere between 2.5, maybe low 3. So you're still looking at twice your mortgage rate to get you off of the sideline. Probably not enough, but we'll talk more about that in the 4 o'clock hour.
Doesn't seem like it makes a lot of sense. All right, let's get you up to speed on Salesforce. Shares moving to the upside this afternoon, now up just over 4%. The move here coming following a report from Bloomberg that the enterprise software company is discussing appointing new board members. The names being discussed include former Carnival CEO Arnold Donald, also MasterCard CFO Sachin Mehra. Now, the report also states that there are discussions about adding Value Act Capital Management CEO Mason Morfitt to the board as well. Salesforce has become a target for activist investors. Most recently this week, Elliott Management, which took a multi-billion-dollar stake in the company. And Dave, like you and I have been talking about this week, when Elliott Management enters the picture, people listen.
Yeah, Patrick Gadsden, who's an activist investor attorney, joined us just a couple of days ago, said they are basically the Godzilla of the space. They get what they want, they take as much time as they want, and they spend as much money as they want to get their results. But he also said that news that Elliott Management was involved here probably was because either talks had broken down or there was some sort of agreement to satisfy Paul Singer / Elliott Management. And it looks like, Shonda, that he was probably fortuitous in that they had some sort of board agreement in place, and Elliott wanted to get credit for that. That's just me reading into that. They wanted credit for that, therefore leaking the story.
Yeah, certainly. We'll wait to see if we hear anything from Salesforce, either confirming or denying those reports. All right, the U.S. economy growing more than expected in the fourth quarter, even as fears of a recession loom. GDP rising 2.9% at the end of 2022. The growth coming slightly below that 3.2% number that we got for the third quarter. Taking a look at where we stand in the market, you're looking at gains across the board. Dow up 138 points as investors digest that data on GDP, but also what we've gotten from earnings from a number of companies reporting their quarterly results. We want to bring in Peter Krause, Aperture Investors Chairman and CEO. Peter, it's great to see you again. So how do you square some of that momentum that we certainly have seen in the market since the start of the year against that slowing growth picture that we are clearly starting to see play out in the economy?
Well, I think the market is anticipating, as you said earlier, Shauna, a 25 basis point increase in rates for the Fed, and probably more importantly, somewhat positive commentary with regard from Chairman Powell on what the future rate increases are. I think the risk in the market right now is exactly that in the near term. Powell could easily say on Wednesday next week that he is raising rates 25 basis points, but he may think that that doesn't mean it's the end of rate increases, and there may be more than one or two beyond that. And that would actually take the market down. So I think the market is kind of waiting to see what the Fed says. I don't think there's a lot of upside in the market right now. There's probably more downside.
But that GDP number in and of itself, is it enough, Peter, to perhaps change the rationale a little bit of the Fed? And does this look anything like a recession, a 2.9 GDP number and a 3.5% unemployment number? Take all the commentary aside, does this have the makings of a recession?
Well, look, you know that the GDP number, which is an annualized number, is backward looking. We know by your chart, actually, that the first quarter and the second quarter of 2022 were negative GDP prints. Traditionally, that is a recession. Now, the National Board of Research or Economic Research has not called a recession, and they may not. But there has been a significant reduction in economic activity on the basis of the Fed moving rates as much as it has. So I think what's going to happen is the Fed is probably going to be even keeled, won't give you much of a view on whether or not there is a cessation of rate increases. The market will be modestly uneven, probably goes down a little bit. And then we get further into earnings season and we see what companies say about future earnings. And my guess is companies are going to be tepid about what they think their earnings look like in 23. And therefore, in the middle of this year, we're going to see a weak market. That will recover by the end of the year. We might have a recession in that time period, but that's what I think is going to happen.
So, Peter, a market that will recover by the end of the year. So where we will stand then at the end of 2023, essentially flat from where we are today?
Yeah, plus or minus 5%. The thing that we're not talking about is the credit markets. Mm-hmm. So the credit markets are set up very aggressively right now. Spreads are tight. People have been buying credit. They've been going out on duration. And there's been no real increase in credit spreads from the need to refinance. And if interest rates don't come down by the end of 23, companies are going to need to refinance at much higher interest rates. Their revenues are not going to be that much greater, could be even less. And that's going to cause some downgrades and some credit risk. And that hasn't played through the system yet.
Between now and the end of 23, though, Peter, what type of decline are we talking about? And because of that, how do you invest into this market?
Well, look, my view on investing has always been don't trade, invest. Equity markets are going to go up over time. We know that. If you're going to trade in the market, it's a very, very challenging thing to do. The market at 4,000 or thereabouts is reasonably priced. It's not cheap, it's not expensive, but it's reasonably priced. You could buy now. Market probably goes down 10 to 15% from here, but you would have to buy at that point, and most people don't. You know, it's challenging to buy in a falling market. So I think if you average into equities over the next 6 months, that's a good entry point.
Peter, one of the common themes that we've heard from a number of our guests over the last couple of weeks has been the opportunity to oversee specifically what's happening in emerging markets and the play here just on China's reopening. How big of an investment opportunity do you see that being for the long term?
That's a good question because you put a time frame on it, the long term. Emerging markets have been underperforming for 10 years, equity and debt, and both are interesting places to invest. Emerging market equity yields are probably between 7 to 8.5%. Emerging market equities have been depressed for 10 years. Is China going to reopen? Yes. When? Who knows? Will China's reopening and India's continued growth drive emerging markets? Absolutely. Are they likely to grow faster than U.S. markets in the next couple of years? Yes. Is it more volatile? Absolutely. Should you allocate capital to it? I would.
All right, good stuff. Got to leave it there. Peter Krause, thank you so much. We are just getting started here on Yahoo Finance Live. Coming up, earnings season rolls on. Financial services company Raymond James reported first quarter earnings. CEO Paul Reilly joins us for an exclusive interview next. Then Senator Jack Reed tells us why he wants an investigation into soaring egg prices. And investing in farmland. New York Islanders captain Anders Lee stops by to explain why he and several other pro athletes are buying farmland out in Iowa. All that in the next 2 hours. Don't go away. Shares of Raymond James Financial falling just about 3.5% today after the investment bank and financial services firm reported slightly better than expected earnings. EPS came in at $2.29, a penny better than estimates, while net revenue came up just short. Let's discuss the quarter and what's ahead for the economy. An exclusive interview with Paul Reilly, Raymond James CEO. Great to have you, sir. Really appreciate the time. We saw what investors think there of the quarter. What about yourself?
Well, Dave, thank you. It's great to be on the show. Had a very, very strong quarter. I don't think many firms projected records this quarter, which we did have a record return to shareholders. And our largest business, our private client group business, had record revenue, record profits, led the industry by far with almost 10% net new assets. I'd say double over the top performers. So we thought it was very, very solid. I think the question investors had is, we're very open and we're conservative. My job is to make sure that this company's a safe haven for clients, our advisors, and shareholders. And we, a year ago, started talking about the cash crunch when we had record cash in the industry. And we've seen now with rates going up, clients, as advisors should have them do, moving to high yield types of investment instruments. And we haven't done any. Most of our competitors have been very aggressively raising higher cost deposits. We haven't. And we announced that we were going to start to do that. We started off with a lot more liquidity, so didn't have to. But if it continues, we are going to roll out the programs and make sure that we have ample cash to operate on. So I don't know if we did as good of a job of communicating that we didn't have infinite amount of free cash. No one does. The whole industry has seen this whole movement, and it's probably impacted us the last. But again, we're in it for the long run. So we've had a great run in share price and valuation, and we have a blip. That's okay. We just have to keep performing.
Paul, I know you're in it for the long run, but the next 12 to 18 months, that really seems to be the big focus among many investors recently. I know you set aside some loan provisions here for credit losses potentially going forward. When you talk about that macroeconomic picture within that shorter time frame, how much worse do you see it potentially getting?
Shauna, that's kind of the, I guess, multi-trillion-dollar question for the industry is, I don't know if we've ever seen a time like this where we saw rates go from prolonged near zero to raise so quickly, even though historically not high rates. So the movement of cash, I don't think anyone knows. We all can use our models and say how much. I don't think we've ever had the consumer so loaded, so much cash in the system, not just in banks, but in non-banking institutions, which drove a lot of the runs in the last year or 2 years in M&A and other activity. We've had a lot of people leave the workforce. I don't know if that's permanent or negative due to those cash buildups, both from government programs during COVID. And so when that all unwinds, we don't know, right? So here our view is we'll look at the long run and we don't know. So we're not going to take the bets. We've got, well in excess of $1 billion of extra capital, which we often get criticized for having too much capital. We don't think in an environment like this, that's, we should do that. We have excess cash on our corporate balance sheets. And the view is, let's see what happens. We're going to find out in the next 6 months what happens to demand, to supply, to inflation. We've heard the debates both sides. You can go on any show and hear, just listen long enough and you'll hear your point of view because it differs all over. And I don't think we really know. So I think the consumer's in relatively good shape. It's going to tighten up. I don't, if you ask me to guess, I don't think it's going to be a hard landing, probably a soft one, but we don't know. So our bet is being flexible and liquid and ride through it as a company until we see the economy turn.
The era of free money being over, what is going to be the impact for the rest of the year? And do you think the Fed will hold rates where after a couple more hikes, fail to cut rates until 24?
I think that it's been interesting to me over the last year, all these predictions that the Fed wasn't going to cut what they clearly said, wasn't going to raise what they clearly said they were going to raise every week. And every time there was a 75 basis points ago, they're only going to do 25 or 50. I think they've been very clear. I think their strategy's been very clear. I don't think they're worried about the stock market. They're worried about inflation and getting that down. Unemployment still low, which is going to be the hard part of inflation to get under control. So I think they're going to stick to their guns, and they'll stop when they see signs. So the trends are in the right direction. They're lagging indicators, but I think they're going to wait till they know. So we could have more in front of us. And again, I think even, we talk about 6% mortgages. I remember when I got my first mortgage, I would have died and thought I went to heaven to get a 6% mortgage. So, when you're used to 6 is a lot, but when you're used to 9, it seems historically like a reasonable rate. So as long as it levels out and people get certainty, I think people will start coming back into the market.
It's very important to put that in perspective. Paul, what about layoffs? That has obviously been a popular topic among the earnings calls. We've seen the layoffs start to creep in to the financial sector. How are you looking at your current headcount, and do you potentially see the need to adjust that headcount over the next couple of months?
Yeah, it's another thing about the way we have governed the firm well, even before me, is that we tend to have a little lower salaries and higher bonus percentage just for these periods. We tend to hire as we need. We try to never get in front. So we still have open positions. We did not hire, and we're still growing. If you look at our growth over the last 2 years, we never hired ahead of that growth. We were always a little behind. So we're in good shape in terms of our employee base. We didn't have the run up. Investment banking isn't the biggest part of our business. It's a very good part and productive part. And so I think, we traditionally have not, had layoffs in our history, except for very unusual events. Don't anticipate it. And I think a lot of the companies you see in tech and others, they were just, if you look at the number of people they hired in the last 2 years, the layoff numbers seem big, but as a percentage of the people they just hired in the last 2 years, it's pretty small. So I think there's a reckoning there. There's still a lot of job openings. I think most of those people will get reemployed. So I think there's still going to be pressure on the labor force.
Yeah, I'm looking at your earnings report. Your headcount's only grown about 5% from a year ago. So comparing that against a lot of the companies laying off workers, clearly a different picture. Hey, Paul Reilly, great to have you, CEO of Raymond James. Well, coming up, shares of... Great to see you too. Shares of BuzzFeed are skyrocketing after the internet media company announced it's planning a major push into AI content. We've got the details for you next. Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Walmart, Apple, and BuzzFeed. Kicking off with Walmart, ticker WMT, the retail giant looking to capitalize on the rise in spending at Sam's Club with plans to open 30 more locations across the country. It's the most aggressive expansion plan that we have heard from the company in years. Now, membership reached an all-time high last quarter. Comp sales jumping 10%. More people are shopping at Sam's Club to save money. They're attracted by those value packs, the cheaper gas, and also the private label products that do, in fact, tend to save shoppers money. Now, new stores will be about 160,000 square feet. That's larger than most existing locations. Dan Halley is here to help us break down all this that we have going on in triple play. And Dan, that last part, the size of the store, the fact that it's going to be even bigger than what we're used to, took me by a bit of a surprise.
Costco's Kirkland, right?
Yep.
Yeah, everybody loves those Kirkland pants. You get a pair of Kirklands, you start walking around, you're basically stunting on people, right? I don't go to Costco. There's or Sam's Club or Sam's Club. But I do want to start going to those because if you ever tried to go to a city grocery store, it's the worst thing on the face of the earth.
But it's hard, but it's just you
So
and
this
your wife.
is like
If you
on your
go,
bucket
you guys are going to
list?
be set for months.
Oh, yeah. I take the car when I go to the grocery store.
I love that you
ridiculous.
aspire to go to these stores.
One day I'll be
someday.
classy enough
What
to go
a
to
goal.
a Sam's Club.
What a goal, man. Hey, man, shoot for the stars,
I'm
Dan.
trying. Well, my pick for the triple play is Apple. They will be reporting their Q1 earnings after the bell next Thursday, but we're already getting some potentially rough news from the tech giant. According to IDC, global smartphone shipments fell off a cliff in Q4, dropping 18.3% year over year. That really hurts. Apple moved an estimated 72.3 million iPhones in the quarter. They saw shipments decline a whopping 14.9% year over year. Now, this is IDC's estimates, not Apple's. But Apple did say that they faced trouble in November and December as lockdowns and worker protests at that Foxconn facility in China, where they build the bulk of their iPhone 14 Pro and iPhone 14 Max handsets cut into shipments. So the fear for Apple watchers is that if there's a decline, it could be an exceptionally poor quarter for the tech giant. You know, you got to think this is a company that lives and dies by the iPhone. They had those shipment problems at that Foxconn facility. The Q4 quarter, or the Q1 quarter, which, you know, we had Q4, now we're going into Q1. This is usually like a lighter time for them. So we'll see what the holiday time, you know, kind of had for them. But
Because they had real supply issues getting the 14 out around the holidays, right? And that's what's
Exactly.
really going to weigh on this report next Thursday.
Yeah, and I got to imagine it's not going to be great. You know, Mac sales, they already said that Mac sales are going to be terrible. So, I mean, not terrible, but less good than they were in the prior year.
Faith in Tim Cook. But it'll be interesting if we're softening the ground for Apple layoffs. That's been the big question with all these tech layoffs. But they only ramped up headcount around 20%, where their peers were well north of 50. So again, a lot of faith in Tim Cook. My play is BuzzFeed. Wow, what a story today. The stock, a rocket ship, a trending ticker on Yahoo Finance all day. The company, the latest publisher to embrace artificial intelligence, announcing it will now incorporate ChatGPT creator OpenAI to enhance its quizzes and personalize some of its content for audiences. An internal memo for BuzzFeed from its CEO, Jonah Peretti, reads in part, the future of digital media will be defined by two major trends, creators and AI. And there's the magic word, adding they intend to build the premier platform for AI-powered content. Also news from the Wall Street Journal that BuzzFeed is getting paid millions of dollars by Facebook parent company Meta to help generate creator content for both Facebook and Instagram. Check out the stock, up at one point more than 150%. It's now still up more than 120. Now you see 130%. Perspective though, folks, this is still a $2 stock. It's still down more than 40% over the last 12 months. But investors are very excited because somebody needed to be the face of AI-generated content. It looks like it's going to be BuzzFeed, but we found out it is riddled with errors, those who have relied on it early on. Exciting? terrifying for a lot of content creators.
It is. It's terrifying, but I also think it's important to point out, like you were saying, it hasn't always worked out. We know CNET started experimenting with ChatGPT back in November. They recently released that information, but clearly there have been some errors in those articles. One was just about how much money you would get if you deposited $10,000 into a savings account that earns 3%. The article said you would actually get $10,300 instead of $300. So CNET had to issue that correction. Yes, this is very exciting, Dan, but I still have some questions just how much people are going to be able to rely and really trust on that information that they're always reading if it is generated just by AI, ChatGPT.
Yeah, I want a job, so burn it all to the ground. I don't, it's interesting because you look at something like ChatGPT, it's not accurate. Right? It's based on data from 2021. You can't ask it what the weather is. Even if you do start to bring it into things like Microsoft wants to bring it into Bing, and they obviously Microsoft's a big investor in that. It's interesting, but it's not going to be the end-all be-all of AI, right? People are impressed with it because it sounds look, when you read it, it looks like natural voice, right? It looks like someone wrote this. You can give it a prompt and it can say something or give you something really impressive. But the reality is, it's not as smart as you think it is. It's just feeding off of what it's been taught. It's not going to be like, this is the very baby steps of AI.
Yeah.
So our jobs are safe.
For now is the key there. Now, they say all their newsroom jobs will remain humans, but once this door is creaked open, it's just a matter of time, when, not if. It is wide open. We should all be. Dan Howley, good to have you here, my friend. Your job is safe. But I'm not paying the bills, so I can say that. Coming up, shares of Tesla driving higher after the EV giant scores an earnings beat. Find out what else has a longtime Tesla bull excited about that stock. Next. Tesla shares rallying today, up now 10 4+% after the company reported fourth quarter earnings, and CEO Elon Musk appears to have cooled fears surrounding dwindling demand for electric vehicles. Here's what Mr. Musk had to say about that demand on the earnings call.
Thus far in January, we've seen the strongest orders year to date than ever in our history. We currently are seeing orders at almost twice the rate of production. So, I mean, it's hard to say whether that will continue at twice the rate of production, but the orders are high.
Joining us now for more on Musk and the Tesla story, longtime Tesla bull and future fund managing partner Gary Black. Gary, good to see you. Can we just say that the price cuts between 7 and 20% here in the U.S. were a success, or is it too early to tell?
I think they're a success. Look, the fourth quarter itself was kind of unspectacular. The gross margins were weak. If you back out all the kind of the non-recurring things in the quarter, they actually missed. But, as you point out, the conference call was pretty successful. Elon got on there and showed a lot of confidence and said the January order is about twice what production is. He even kind of hinted, well, maybe we could even do 2 million units in 2023. And that's what's pushing the stock up 10% today. It was really the outlook on the volume side, which was a result of cutting price about 3 weeks ago now. Stock's up almost 50% since they cut price. So that's a tell.
Gary, what about recession? It came up a couple of times during that conference call when you talk about demand, a looming recession. That, of course, you would think would be a big risk, but Musk actually had a positive spin on it. In part, he said, if the recession is a serious one, we expect to see deflation in our input costs most likely, which would then lead to, yes, better margin. Do you buy that?
I don't think investors listen to Elon's economic forecast. I think he's viewed as a great engineer, a great product guy, a visionary about climate change and accelerating the world's transition to a sustainable world. But he's not an economic forecaster. I think most people, including myself, believe if we have a recession, it's going to be extremely shallow because the Fed could cut rates any time, and they probably will. So I don't think people are buying into that there's going to be a recession. I think what people are excited about is, remember last year, fourth quarter was disaster. They, were cutting price in China. They were promoting the hell to try to get to a number in the fourth quarter in the U.S. And it looks like when you hear them talk yesterday that the volumes are surging. And so now people are thinking, okay, well, the 2023 volumes will probably be pretty good. And people are even talking first quarter numbers north of 450,000, which would be a really big number. So I think that's what's got the stock on a move. And people are not really paying too much attention to him saying, maybe there's going to be a recession or there's probably going to be a recession because that's not his skill set.
I'm glad to hear you say that because most of us are trying to square the circle of a pretty difficult recession with demand for 2 million EVs, which is kind of difficult to reconcile. Okay, so in terms of the margins in Q1, how concerned are you given those price cuts?
So my margin expectation is about 23% for 23, and I'm looking for about 1.9 million volume for the year. So I think I'm probably a little bit more optimistic than the average street. The street's really come down. If you look at estimates for 2023 since the beginning of the year, they're down about 16%. But, to your point, the stock is up year to date almost 30%. So I think most people are saying we're going to give them a pass for first quarter and even for the year if the margins are light, but they got to hit the volume numbers. And then people are looking for other catalysts from Tesla for the year. So it's not just, the volumes doing better. People are assuming that he's going to give up his CEO role at Twitter, which would be a positive. They're going to at least announce probably 2 or 3 more gigafactories because they got to get the volumes up to, say, 10 million by 2030. And the most important catalyst is Cybertruck. Cybertruck, we've been waiting for 4 years. There's 1.3 million pre-orders. That is a huge catalyst if they can get that out by the end of the year and in early next year. And there's one more thing that I don't think the street's paying much attention to. It's called megapacks. And they're these they're basically cells of batteries that they sell to utilities for peak demand. And those things run for about $2 million each. They had a factory come online at the end of third quarter in Lathrop, California, that has a capacity of 10,000 units. So even if you sold, let's say, 2,500 units this year, that's a huge boost to revenue and earnings, and nobody's really paying attention to it. So I think there's a lot of catalysts for this year, and that's why, again, I think the stock is on the move today.
Cybertruck being the big catalyst. I've had some questions about that. I'm still skeptical looking at the design of it and everything. But Gary, I'll take your word.
I want to know if Gary'd drive that.
Yeah, Gary, would you drive that?
I have an order in the Tri-Motor. I live in Chicago. I can't wait to drive it up to Nobu in Chicago and leave it there and have all the kids take pictures of it. I mean, it's going to be, it's so radical looking that you either love it or you hate it. And I think it's beautiful. I think it's going to be a huge seller, and it's going to open up Tesla to we'll call it the under 40 market. Those are the people who are going to buy it. It's not going to be, I mean, it's going to be priced where Model Y is. So it'll probably start at 49. The biggest one, which will be the Tri-Motor, will be 69. But think about this. It's going to ride like a car. It looks like a spaceship. And it's going to be 0 to 60 in 3 seconds. What could you not like about this?
All right, you're doing a good job selling me on it. I'm still not fully sold, but I'm in that market that you were saying that people that it would be popular amongst.
Your man will like it. Your man will like it.
All right. Gary Black, great to have you. Thanks so much for joining us. Well, coming up, scrambling for an answer, Senator Jack Reed is calling on the FTC to investigate surging egg prices. And then we'll speak to the CEO of egg company Vital Farms for his stake. Stay with us. The U.S. reaching an agreement to send tanks to the front lines in Ukraine's war with Russia. Ukrainian officials welcoming the news while also pressing for more support, including fighter jets. We want to bring in Senator Jack Reed, who is chair of the Armed Services Committee, joining us now to discuss. Senator Reed, it's great to have you here. Thanks so much.
Oh, it's great to be with you. Thank you so much.
So while some lawmakers did oppose this decision, it did get support from key congressional leaders on both sides of the aisle. Where do the discussions now stand on sending those jets that Ukraine wants?
Well, I mean, the first issue is the capability of the Ukrainians to use the equipment effectively. Then the second issue is, you have to continually evaluate sort of the potential for escalation. I think at this point, and I was in Ukraine about 3 weeks ago with President Zelensky, that the provision of fighting vehicles and tanks and air defense systems will give them critical leverage as they start a spring offensive, and they can exploit that. The airspace in Ukraine is not even used by the Russians because of the extensive anti-aircraft defenses. So again, I think the first priority is to get those fighting vehicles and tanks into the theater of operations.
Senator, nice to see you. You're just back from Ukraine. You got to look firsthand at the situation. We saw a video of you meeting with President Zelensky. Your sense of where we are in this war 11 months in, and is there any end anywhere in sight?
Well, I think, first of all, there was remarkable courage by the Ukrainians and also by President Zelensky, and that has made a critical difference. And also the exposure of the capabilities of the Russians. They weren't quite as capable as we thought, and certainly not as capable as they thought. And now we're into a situation where the lines have hardened in the south and in the east of Ukraine, and each side is preparing for offensives when the weather improves in the spring. It's critical that the Ukrainians are successful in their offensive operations, they're able to exploit them. And also, at that point, I think they'll have political leverage to initiate or begin, or at least to have Putin consider more thoughtfully a ceasefire or something like that. But at this point, they've got to keep winning, and the more they win, the more likely they'll get to the table to negotiate.
Certainly, hopefully will be the case. Senator Reid, we also want to turn just domestically to an issue that I know you're tracking very closely, something that's clearly affecting your constituents, that's inflation. You're focusing on the massive jump that we've seen in egg prices. They're up 138% in December on a year-over-year basis. You recently sent a letter to the FTC asking the FTC to look into the massive price hike. What do you think is going on there, and what do you think is behind this massive jump that we've seen in the last 12 months?
Well, I think what's is happening is that some major egg producers, not the local folks, because they're still harvesting their eggs in their backyard or the small plots and then selling them at a reasonable price. But some of these big companies are basically exploiting the potential to increase prices. It's gone up, as you say, 138%. Inflation is far, far less than that, so it's not inflation. The supply chain is, I don't think, affected. It's not an international business. And then the issue of avian flu, as someone suggested, would not account for that type of supply increase. And what they're doing is essentially keeping their production level and just raising the price because it's an essential. Families need the eggs. It's just a part of everyone's daily life. And instead of responding in a market way, which would be decrease production to match increased demand, they're just sitting back and taking the profits. And I don't think if they have that market power, they should not have it. And that's why we've asked the FTC, and also we'll ask the Department of Justice to look at this.
And Senator, is this price gouging that you're accusing them of? And where do you draw the line between gouging and simple supply and demand?
Well, if you look at gross inflation, it's about 12% other products. You average it out. This is 138%. So if you get to the arithmetic is 10 times what the other inflation is, that's very suspicious. So this is more than, I think, excessive. This is just indefensible.
Senator Jack Reed, really appreciate you being here with us. Thanks so much.
Pleasure. Take care now.
You too, sir. There are two sides to the story of eggflation. Joining us now is Vital Farms CEO Russell Diaz-Canseco. Nice to see you, sir. Egg prices up nearly 60% in December versus at-home food increases just less than 12%. How do you justify these skyrocketing prices, sir?
I don't. We sure haven't raised our prices nearly as much as you are discussing. And I'd hate to be characterized as taking the other side of Senator Reid's argument, because in many respects, it's a head scratcher for us as well. You know, over the course of 2022, we certainly saw inflationary impacts to our key inputs, like the grains we feed our girls and the diesel fuel that the truckers use to fuel their trucks as they deliver the eggs to the grocery stores. We've Our approach to price increases has been to take them reluctantly in small amounts and typically in arrears, meaning after we've already seen the impact of cost increase. That showed in our financials over the last year a compression of our gross margins, which a lot of investors asked me about and wondered why I didn't take prices higher sooner. The reality is we're building a brand for the long haul, and we've grown our supply year in and year out for 15 years straight. We don't see a short-term supply and demand shock as an opportunity to just goose our profits, and that's not how we're operating. So I'm as befuddled as the senator is about why we're seeing inflation that's multiples of the inflation on the inputs that we use.
And I want to dive into that a little bit about response that you're getting from investors here. Last year, you had a record revenue of $92 million, up 42.4% year over year. Gross profit was $29.5 million compared to $19.8 million in 2021. When investors come to you and say these numbers, reiterate them to you, what's your response there?
So some of those numbers don't sound exactly like what our results have been. What I'd say is that we saw gross margins starting with a 2, gross margins in the 20s in the back half of last year on the back of real inflation in input costs. And that was a relatively low gross margin for us. Our hope in 2023 is that with the price increases we put through, we can just get back to where we were a few years ago. And we certainly are not expecting to see outsized or record gross margins over time, because for us with the branded premium product that we bring to the market, it is a competitive market, and we want to continue to make it available to more and more Americans. We're only in a single-digit % of U.S. households. Our goal is to be the biggest egg brand in America, and we have a long way to go. And we certainly don't want to choke off our growth by overpricing our product.
Russell, speaking to that goal, how do you plan to get there? And when you take a look at the current landscape right now, clearly supply chain challenges has been something that your industry has been dealing with. How have you navigated that more recently, and how long do you see some of those challenges sticking around for?
You know, it's so interesting. Our supply chain is so different from what I think the large egg producers have. We work with over 300 small family farms across 8 states in the South. And we buy eggs exclusively from those farms, and they sell their eggs exclusively to us in multi-year contracts. The price we pay them is predictable for them, and we increase prices when grain costs go up so that they aren't upside down and stuck kind of paying the bill for inflation that we're seeing. The net result of which is we have a pretty reliable supply of eggs for our business, and they have a pretty reliable, cash flow for their business. Those things create resilience. And I think sometimes the pressures that especially public companies face to maximize profits in the short run lead them to underinvest in things that we take pride in investing in. For example, we spend millions of dollars every year in people, training, and other resources to help our farmers be the very best egg farmers they can be. Now, in any given period, I could be more profitable if I didn't spend all that money. But the payoff comes when we hit a challenge like the industry is seeing right now, and our farmers weather it and come out with flying colors. We've had very limited impact from avian influenza, for example. And I think that's because we just focus a lot on keeping our birds and our farms safe from it.
Sir, I just want to come full circle and be clear about this. It sounds as though you actually agree with Senator Reid, without naming names, that some are price gouging when it comes to the prices of eggs.
All I would say is that it's a head scratcher for us. I don't see anything in my cost structure that would have led me to raise our prices by as much as you're reporting. We've taken just enough price to sort of keep ourselves whole and continue to pay our farmers, an appropriate profit for the work they do. I'm not suggesting anybody's price gouging. I'm just saying I can't explain why prices have gone as high as they have.
And very quickly here, you did just announce a new national food service relationship with True Food Kitchen. Where do you see that in your growth expansion? And ultimately, how do you see this rolling out nationally?
Yeah, so we love partnering with food service brands like True Food Kitchen that kind of share our values. They're doing such a great job of bringing healthy, clean label, nutritious food to more and more areas of the country. My family loves to eat there. And in fact, it's my wife's choice for Mother's Day brunch. And so we're just thrilled to be able to partner with them. And I expect that with the next menu rollout, we should be on many of their menus throughout the country.
All right, come see us here in New York. We'll have a little egg sandwich next time, all right?
Look forward to it. Good to see you.
Good. Vital Farms CEO Russell Diaz-Canseco and Brooke DePalma, thank you both. All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live. All right, we're just a few minutes away from the closing bell, so let's bring in Yahoo Finance's Jared Blickery to break down today's market action. Hello, sir.
Hello. Let's start out with the energy sector. By the way, energy sector, the leading sector today, up 3%, followed by all the mega cap sectors, XLY, XLC, XLK. We'll get to some of those in a minute. Let's check this out, because tomorrow morning we're getting Chevron earnings. Today we are getting an announcement that they are increasing their buyback to $75 billion. This is on top of their existing authorization. They're also hiking their dividend. No expiration date on the buybacks, but RBC expects the oil major to ratchet up the monthly pace. JP Morgan also believing that this could signal better guidance in Chevron's announcement. Tomorrow morning, we're going to bring you to that live. And let's just take a look at what's happened in the energy sector this year. We know is one of the best, well, it was by far the best sector last year, but we can see Schlumberger up 7%, Exxon up 6%. We're going to be getting to a lot of those energy earnings in the coming days. Also want to check out something called Sherwin-Williams here. And if I can find my home builders screen, we're going to see that that is down substantially. Sherwin down about 8.5%. And well, I'll tell you what, the only thing worse than watching paint dry is watching your portfolio shrink, because guess what? Having its worst day in 2 quarters, and that's after delivering a full year forecast that disappointed. Now, we know the housing sector has been battered and bruised, and Sherwin, as a proxy, is now issuing a warning. Here's the CEO saying, we will not be immune from what we expect to see to be a very challenging demand environment in 2023. Visibility, that's beyond our first half of the year, that's going to be limited. So, caveat painter here, and let's get back to some of the meme stocks that we've been talking about most recently. Bed Bath & Beyond. Let's get to the intraday. We got that right there. Bed Bath & Beyond has so shrunk that it's hard to find on this screen here. Let me just sort by equal weight here, and we can see at the very bottom, there we go. There have been several price halts today due to volatility, and that's based on the explanation that they gave in their 10Q or 8K today, saying that they may have to file for reorganization. That means Chapter 11. So it looks like we got about a minute left here. Let's just cycle through through some of the happenings today. We checked out the sector action before. Let's check out our market leaders now. KWEB, that is a Chinese ETF. That is in the forefront. That's up almost 3%. But then we have IGV. That is a software tech ETF. FDN is internet ETF. So those leading is actually pretty strong. Ahead of ARK, even stronger. We're also seeing some strength in the chip stocks. All of these on the top line are outperforming cannabis stocks and this liquidity, this US bond ETF. Those are the only ones in the red. Now, as promised, here's the Nasdaq 100 where we see the mega caps cooperating. We see Microsoft up 3% after its earnings the other day. Tesla up 10%. We're going to be bringing you Intel after the bell, so stay tuned for that in just a few minutes. Other than that, even Meta's up 4%. Didn't see really any news about that today, but it's nice to see all this green. And on that note, we're going to send you off to the closing bell on Wall Street.
Terrific organization right there.
It is
Big
a
brothers,
terrific
big
organization.
sisters, love helping them out.
So do I. And look at
Kudos
that. They're
to
wearing the green jackets there, and it's very appropriate given the gains that we're seeing across the board. The Dow closing up just over 200 points. S&P up just over 1%. The Nasdaq, the outperformer of the group. Jared was just talking about some of the rallies that we're seeing in those big tech names. Looking at the Nasdaq up about 200 points today. Let's talk about some of those individual movers. And with that, kicking off with Tesla. Tesla closing up just about 11%, the leader in the Nasdaq 100 today, closing at its highest level that we've seen in the last 6 months. After fourth quarter results came in better than feared. Now Wall Street reacting positively to the numbers and the comments about strong demand from CEO Elon Musk. We had Citigroup, Bank of America, Wolfe Research, Wells Fargo, Cowen, Wedbush among the names there raising their price targets today. And Dave, taking a look at the momentum that we're clearly seeing in Tesla stock. We talked to Gary Black earlier in the show. He's a future fund managing partner there, clearly a Tesla bull. He was saying that the Cybertruck is going to be one of the huge catalysts, get people back on the hype train when it comes to Tesla and really take it back to those higher levels that we had seen. When you take out some of the losses that we've seen over the last 12 months, I'm not sold yet, but clearly the street very encouraged by what we did get from Tesla and by the commentary that we heard from Musk.
Are you on Team Briggs with the Cybertruck? Because look, I just don't see it. I understand.
And you love pickup trucks. You love trucks.
I love trucks and I love Teslas, but that car will not be driven by most Americans. It frankly will not. And people always use the pre-orders as the real catalyst. Those pre-orders are fully refundable, $100 fully refundable deposit. I'm not buying it. But he also pointed out they're not just a car company, Gary Black, and pointing out that mega packs, for example, could be a real catalyst for tremendous earnings down the road. But he said something really interesting as well about Elon Musk's macro talk about the economy. He said investors really don't pay attention to it. But the problem is Elon Musk on that call really undermined his own argument on that call by saying we're going to go through a pretty difficult recession and then saying he sees skyrocketing demand for very expensive EV, that is the Tesla, and the potential for 2 million. So how do you, even if he's wrong, how does he justify in that brilliant mind that there's going to be a recession while there's going to be tremendous demand for Teslas? I don't see it.
Yeah, something's not adding up there. But I think maybe the positive spin on this, at least from the street's perspective, Deutsche Bank did weigh in on this. If in fact we do see a slowdown, they were saying, obviously not great for Tesla, but the company is better positioned given its cash position, given the levers that it does have at its disposal than some of the competitors out there. But you got to question, if we do head for a recession, maybe a larger downturn than what we are anticipating at this point, it's not going to be good for Tesla. It's not going to be good for many consumer-facing companies.
I would have just liked to hear his justification for why he sees that coming. Just one other note, his CFO I thought was interesting in saying we're going to, quote, attack every area of cost that does play into the potential for a recession, and maybe that's helpful in cutting the cost of the supply chain. So that was interesting. All right, more earnings news. A reaction in the market today with several airlines moving following quarterly reports. American, JetBlue, and of course the one we've all been waiting for, Southwest, reporting today. But you can see Southwest, the loser of the bunch today, the company revealing a $100 million loss due to that holiday travel meltdown in December. Their CEO, Bob Jordan, telling Bloomberg, quote, "We know for a fact we were absolutely staffed to operate our schedules. I do not believe the issue was staffing." Now, these comments coming on the same day Southwest says it plans to hire 7,000 workers in 2023. So still a bit of a mixed picture from the airline after it canceled 16,000 plus flights in late December. And that isn't just a drag on this quarter, but probably Q1 2023. And Shauna, quite frankly, maybe well after. Remember their pilot captain of the union, Casey Murray, told us, I asked him, if you were a customer right now, would you fly Southwest? And he said, point blank, no way, and laid out the reasons for it.
Yeah, I think we certainly are seeing some of that overhang from all the flights, over 16,000 flights canceled. Clearly, they are seeing cancellations, something that CEO Bob Jordan talked about on the earnings call. What surprised me was the fact that he only sees this as being a Q1 issue. I do tend to agree with you, Dave, that I have a hard time buying that maybe some people are going to be a little hesitant when booking with Southwest into Q2, maybe even Q3. But when you take a look at these numbers, clearly it's going to be a challenging several months here for the airline. The company did say that they do expect a negative revenue impact of $300 million to $350 million in the current quarter. Whether or not that, of course, drags on to the second quarter, only time will tell. CEO Bob Jordan also going on to say that they are working with a consultant firm to try to determine some of those issues. To address those issues, it's going to take a huge investment. And like we've talked about time and time again, it's a fix that's not going to happen overnight. It's going to take some time. So Southwest currently has their work cut out for them.
I was just curious why you thought JetBlue was down slightly on a really good report. Is that because the good news is already baked in? Already had a pretty solid month?
Yeah, they've had a pretty solid month. And when you take a look at some of those larger charts, you have seen longer term charts, I should say, you have seen a bit of a rebound more recently. The stock barely closing negative there. But like you were saying, it was a very different quarter than what we just heard from Southwest. They said that they were on track to deliver those cost reductions that they have been targeting of $250 million through 2024. The CEO saying that the demand environment remains solid this year. So clearly, totally different picture over at JetBlue. Let's take a look at MasterCard because shares of the credit card company closing lower here. You can see off just over 1% after the company warned that revenue growth could slow faster than expected in the current quarter. Still, though, MasterCard's CEO saying in a statement that, quote, while macroeconomic and geopolitical uncertainty persists, consumer spending has been remarkably resilient. He then went on to say, we are well prepared to adjust our investment profile quickly if needed. So it's interesting just to weigh that against the reaction that we're seeing in the stock price today. And taking a look at the analyst reaction here, they actually said that trends in January look, quote unquote, healthy so far. So a drop of 1%. Not too much to be worried about.
No, and it's so interesting. Again and again and again, we hear these predictions of recession and more from the earnings call from their CEO. Pointed out strong labor market, low unemployment, rising wages, elevated consumer savings levels. And it's a lot like we heard from Paul Riley, Raymond James CEO, early in the show saying, I just don't see it. We don't see it in our clients. We don't see it in our customers. But we're going to prepare for it. So it's a strange dichotomy going on with this economy where everyone's coming out and saying we don't see a recession in our customers and our clients, but we're going to potentially prepare.
Hopefully we don't see it.
Yeah, hopefully we do not. Hopefully we do not in these earnings reports because we have them in from Intel, and you can see probably not a good report, down 5.5% after hours on their latest earnings. Let's bring in Jared Blickery, who has the earnings numbers for us, presumably not good ones.
No, it was a miss on both the top and bottom lines, and the guidance even worse. Let's talk about the fourth quarter right now. That's a $14.04 billion for adjusted revenue when the estimate was for higher at $14.5 billion. Now that breaks down into client computing, network, and mobile eye revenue, also Intel Foundry Services, but mainly client computing revenue. That was a big miss, $6.663 billion. Estimate was for $7.42 billion. Network and edge revenue, $2.06 billion. The estimate was for $2.21 billion, and then Mobileye, that's spinning off, but that came in at $565, besting the street's estimate of $435 million. Now, adjusted EPS, I said, was also a miss. That was 10 cents versus the estimate of 19 cents. Operating margin, disappointing, 4.3% versus the estimate of 7.22%. And then finally, for the fourth quarter numbers, I'm going to round this out with adjusted gross margin, 43.8%, a miss, below the estimate of 45%. Now here's where we get into that forecast. They're seeing first quarter adjusted gross margin 39%. The estimate was 45.5. Intel sees first quarter adjusted loss per share of 15 cents. Guess what? The estimate was for a profit of 25 cents. So that going in the wrong direction. It's also seeing adjusted revenue $10.5 billion to $11.5 billion when the estimate was for almost $14 billion. So they're looking to make $8 to $10 billion in cost reductions by the end of 2025. And you know, Pat Gelsinger's turnaround strategy probably under a bit of scrutiny here. There's going to be some tough answers for him to field on the call, should he be there, which I would expect him to. As you can see, some of the other chip makers down in sympathy. NVIDIA down 1%, AMD down 2%. And let me just get to a quick chart of Intel here over the last few years so we can see what's happened over the pandemic. Basically from the upper left to the lower right here, and that is not the best way for a chart to be situated, down 56% over that time period. Guys.
Ouch. Not much to like there, Jared. Excellent job breaking it down, my friend. Thank you very much. Coming up, we take a deeper dive into Intel's fourth quarter results. Is there anything to like? We'll find out next.
Let's take a look at shares of Intel. You can see it off nearly 6% here after hours. A company missing on both the top and bottom line. Also, its guidance for the current quarter coming in a bit light. Let's talk about it, what it means going forward. We want to bring in Patrick Moorhead of Moorhead Insights and Strategy, founder and CEO. Patrick, great to see you here. So first, Street's obviously concerned about these numbers. What's your take?
Yeah, this was not a pretty quarter at all. And there's really three things going on here. First of all, there's some macroeconomic issues that are weighing on it. PC market is down 30%. Intel was down more than that, but I think that's really just a inventory balancing. The biggest thing is Intel's in the middle of a multi-year transformation. You know, it got into this huge foundry space with IFS, so huge capital expenditures around the world. They're entering new markets like graphics and AI. They're even re-architecting their chips to use chiplets and 3D packages. And the third thing is competitive pressure, right? AMD and servers and PCs, and also pressure from homegrown chips developed internally by companies like Apple and AWS.
They were, at least at one point not too long ago, kind of the leader in this space. What's happened to that leadership position?
Yeah, so first of all, they do have 80-some% market share in both of these giant markets. one thing that happened is NVIDIA got the jump on using GPU as a chip for AI. So that pulled away some of that revenue. The biggest issue happened 3 or 4 years ago that Intel is still trying to make up for, and that was challenges in the core technology to make chips. The smaller you make the chips, the faster performance you can make them and lower power. And they took what I consider a 2-year lead and turned that into a 3-year deficit. And that's what they're in the process of doing now. And turnarounds for a chip company, those don't happen in a year. These are 5-year bets. And the latest information that I picked up from Intel CEO Pat Gelsinger is that they are still on track to hit these 5 what are called nodes or manufacturing technology transitions in 4 years.
Patrick, is this the time you expect to hear some heavy criticism of Pat Gelsinger, who made $180 million in 2021? Still haven't heard what he did last year, but are you expecting those calls to be louder?
Yeah, I am expecting that, primarily for the people who don't understand the semiconductor industry, because here's the challenge. Unlike any other technology out there, these are 5-year bets and quite frankly, Gelsinger came into a challenge. Not only were his products not nearly as competitive as they needed to be, but his manufacturing was behind by over 2 years. But even with that said, there will be cries, there will be some criticism out there. And I do understand this, but this isn't like a consumer packaged goods company that can turn up the spigot on marketing or turn down the spigot on marketing and make something happen. This is real science. This is real technology. And, I'm actually bullish about Intel's future, but I think it's going to be a challenging 12 to 18 months out there, potentially even longer if the economy doesn't help the company, because a very large percentage of its cash dollars, its profit dollars, come from the PC market that right now is absolutely in the tank. The good news is the data center market is still it's still cranking. I mean, we're probably going to see 19% growth in this fourth quarter, and because these investments buttress consumer services, you can't just turn those off. And these hyperscalers are doing their build outs. I think there's still going to be demand in those areas.
Patrick, given the fact that the stock's down, over 40% in the last year, you mentioned the tough PC environment, obviously tougher competition. Has all of that risk been already priced into the stock, or do you think we can kind of see a little bit more downside risk ahead for Intel shares?
Yeah, I don't, unless there's, this all centers around what CEO Pat Gelsinger says, 5 nodes or 5 shifts in 4 years. I believe if Intel can hit this trajectory, and the company is releasing a lot of detailed information on that, I don't think you're going to see a massive decline outside of something that might happen in the sector. So what I'm talking about are self-inflicted wounds, and so far so good, but that's what investors should be keying off of, because that is the key to this company's turnaround.
All right, Patrick Moorhead, appreciate that. President Biden addressing his administration's economic progress today, speaking from a steam fitters union hall in Springfield, Virginia. Here's what he had to say.
We're moving in the right direction. Now we got to protect those gains. We got to protect those gains that our policies have generated. Protect them from the MAGA Republicans in the House of Representatives who are threatening to destroy this progress.
Joining us now, senior columnist Rick Newman. Rick, how does taking aim at House Republicans bode for the president's agenda?
We're going to be hearing a lot of this during the next 2 years, I guess. So Biden's basically doing 2 things. He's going out and touting the legislation that got passed during his first years, and he's tying that to what is generally pretty good news in the economy today. We saw that GDP growth in the fourth quarter of 2.9%. Biden is saying, look, that has a lot to do with the bipartisan infrastructure law he signed in 2021. There was the CHIPS Act over the summer last year, and then the Inflation Reduction Act. and inflation is actually coming down, even though the Inflation Reduction Act didn't really address inflation at all. We've talked about that a lot before. So that's part one. Part two is he's just going to be trashing what Republicans who now control the House of Representatives have been doing, including this proposal by some of them, not all of them, but by some of them, to abolish the IRS, get rid of the whole income tax structure, and instead have a 30% flat tax on consumption. So under that idea, there'd be no corporate income tax. Wealthy people would pay no income tax, and instead we would tax purchases, healthcare, and things like that. Even Kevin McCarthy, the Republican Speaker of the House, does not like that idea because I guess he realizes taxpayers are sitting there like, what are you talking about? Increase the tax on bread while killing the corporate income tax? But there are some Republicans in Congress who support that, and that is just giving Biden all kinds of material to take as he goes around the country talking about the economy. So this is what Biden's going to be doing for the next couple of years.
And Rick, and then of course there's also the criticism there from administration officials about the House GOP that they are going to restrict the releases of the SPR or press for that. In terms of what Biden needs to get the message across to voters, to get some of those people who have been a little bit critical of how the last 2 years have been handled, what do you think that message needs to clearly state?
Well, let's remember that none of these ideas, whether wacky or sensible, that House Republicans have, none of them are going to pass Congress because Democrats still control the Senate. And even if they didn't, President Biden would veto stuff like this. So really, it's just messaging. But it's good timing for Biden and for most Democrats because we are effectively now in the 2024 election cycle for both president and once again, the control of Congress. So Republicans think they are using their control of the House of Representatives as a big messaging exercise to say, look, if we were in charge, this is what we would do. Polling has shown this is not popular. I mean, McCarthy is not popular. Voters do actually think that Republicans are kind of trying to sow chaos, and that is a word Biden is going to be using over and over. He used it today, the word chaos. House, the MAGA Republicans sowing chaos. Why would anybody want to introduce chaos when the economy is going well, is basically what Biden said today. So these Republicans seem to be helping Biden. They have a constituency. It's sort of the let's blow everything up constituency. But as we saw in 2022 and of course in 2020, that is not what most voters want to do. They don't want everything to blow up. They sort of want everything to run smoothly and to not hear a lot about what's happening in Washington. So this seems to be working in Biden's favor for now, but of course, long time till the next set of elections in 24.
2 more years of this. All right, Rick Newman, thanks so much.
Yes. See ya.
All right, well, coming up, Americans are streaming more than ever. We have the numbers to prove it. Plus, a new survey revealing what Gen Zers are looking for in the workplace. Stay tuned for the results. How much TV is too much TV? Data analytics company Nielsen may have found out. Americans get to stream more than 19 million years worth of content last year in 2022. That's according to Nielsen. That's up 27% from 2021. Yahoo Finance's Ali Canal is here with us. And Ali, clearly lots of binge watching seem to be going on. What shows came out on top?
Oh, yes. And according to this report, the 2022 streaming champion was Netflix. Now, Nielsen looked at top overall programs, top originals, top acquired content, and then top streaming movies. And out of all of those categories, Netflix was a winner 39 times out of 58, followed by Disney Plus, with HBO Max sneaking in there thanks to Friends, which ironically it acquired from Netflix back in 2020. But if we take a look at the top 5 overall programs, that included hits like Stranger Things, NCIS, Encanto. But I want to zero in on original programming because this is where Netflix really shines. And it's a testament to the steep investments the company has made in its programming over the past years, especially for the more episodic content that we see from them with titles like Wednesday, Ozark, Bridgerton, making the top 5 list. And while Netflix does have a few popular movies, Disney actually had the most success when it comes to streaming films. That Disney IP just seems to hold a lot of weight with consumers and remains one of the main drivers for Disney Plus subscriptions. So super interesting to see all of this data laid out, since at the end of the day, the streaming war is really just a content war. And I think that's why we've seen Netflix continue to be successful and to continue to dominate this space. We'll see if the competition can eventually catch up, especially as they make their own respective investments. But for now, it's clearly a Netflix and chill type of vibe going on out there.
Well, that's not great for this next company we're about to talk about, because Comcast was out with fourth quarter earnings, and that streaming war tends to get very expensive. And is that what stood out for you from the report as far as Peacock goes?
Absolutely. And it was a very interesting report with Peacock because on the one hand, we did see an addition of 5 million new subscribers. But on the other hand, they reported a loss, nearly $1 billion just in that Peacock division. And this is a narrative that we've really seen across the media sector. More growth usually comes at that pretty steep cost. You can take a look at Disney as another example of this after that company reported a loss of $4 billion plus in its fiscal 2022 results. But on the Comcast earnings call earlier this morning, executives did maintain that they expect peak streaming losses in 2023, estimated at about $3 billion. And they did remain confident that Peacock is the right business model for the company at this time. We heard from Jeff Shell, he's the CEO at NBC Universal, and he said that they would not be investing in Peacock if they did not expect the streamer to lift the overall media segment to growth over time. Now, over time, that's very broad, and Shell did warn that there are a few macroeconomic factors that could weigh on that timeline, such as the ad market recovery, linear cable declines, cost cuts, etc. But for now, it was very clear on the call that they are not abandoning Peacock. They're not abandoning streaming. They do have more than 20 million subscribers on the Peacock app, which is more than double the 10 million users the app had this time last year. So overall, not a bad quarter, but again, those macroeconomic headwinds and those accelerated losses did seem to overshadow things a little bit this morning.
Something for the Bulls, something for the Bears. Ali Canal, thanks so much. Appreciate that. Time now for old people talking about Gen Zers. Adobe is out with a new survey talking about Gen Z in the workplace. Gen Z expected to account for 30% of the U.S. workforce by 2030. That's according to Adobe. And they have unique challenges ahead of them with fears of a recession and the pandemic-led rise in remote work. 70% surveyed say they are worried about a recession. Many of the college students and recent grads say they are saving money ahead of a possible downturn.
And Dave, those macroeconomic factors are clearly having an impact because 67% in this survey say that those macro factors have influenced or will influence their job choice when it comes to picking an industry or a company. 55% will look at a company's financial outlook before applying. 85% say that they're less likely to apply without a disclosed salary range. We know that's a very popular topic of discussion. This one, though, is a little surprising considering the appeal of remote work. 75% say that they would be willing to relocate to be closer to work. Clearly, they're emphasizing that Gen Z does see a value of coming into the office. I think the big question there is how many days they really want to come into the office. Most likely, they probably want some sort of hybrid situation. Another stat that did stick out to me was the startup and how only 16% saying that they would pursue a role with a startup or a small size company. Now, I'm a millennial, but I know there was so much excitement when I came out of college of people wanting to work in a startup. And that was in the middle of the recession, of the Great Recession. Still, startups were attractive. A lot of people found that the growth that you could have there, the experience that you could get, it was willing to take that risk. That certainly does not seem to be the case now. Maybe they learned from our mistakes.
That and recessionary fears. And of course, I'm the Gen X here. So as far as the being willing to relocate closer to a job, I think young people, regardless of what generation they're labeled with, they don't have a lot of attachments. They don't really care to be home all the time. In fact, they want a more social environment. They want to have happy hour. So that probably all lends itself to being in the office. And hopefully they want to learn in their first job, because that is all you want to do in that first job, is really learn for the job that comes after it. As for the rest of that entire survey, I'm curious to see how that changes over the next 12 months, because if in fact their recessionary fears do come true, they won't be as empowered as clearly they are in that survey. They won't have those choices. They won't have that flexibility. They won't have the strength to argue for these things. So that is really a representation of how tight the labor market is right now. And that dynamic may soon change. I think really the most interesting trend we're seeing among that group is wage and salary transparency. And I think that's going to be better for all of them. And quite frankly, I hope for all of us.
Yeah, I think so too. And I also think it's important to point out that those salary ranges, while there has been increased transparency, some of the ranges that are posted are mind-boggling. There was one, 90,000 to 900,000, didn't really do you any favors just in terms of narrowing down what you should be paid or what you could be paid in that role. But again, I think the step towards more salary transparency, and people also, especially the younger generation, are more prone to talking about it. They think you should be talking about salary transparency. So again, a huge focal point here for Gen Z when they're looking for a job. All right, coming up, New York Islanders captain Anders Lee is finding ways to score away from the ice. He'll tell us about his latest business investment next.
More than 30 years after Kevin Costner forever connected baseball to an Iowa farm in Field of Dreams, a group of professional athletes from the NFL, NBA, and NHL are collectively invested in Iowa farmland. Bengals QB Joe Burrow, NBA star Blake Griffin, and New York Islanders captain Anders Lee, all part of an investment group led by private investment platform Patrikoff Co. Anders joins us now along with Patrikoff founder and CEO Mark Patrikoff. Nice to see you guys.
Thank you.
Pleasure having you here. So Mark, I want to ask you first, why a huge group of current and former professional athletes, and how did you get them together?
So first of all, to me, having been an investment banker for a long time, I understood that access to the best deals is what we're all looking for. And I had met a handful of professional athletes by co-hosting a television show with Rob Gronkowski a few years ago, a kind of a Shark Tank for pro athletes, nothing you need to look in the video library to see. But I kind of learned over the course of the 36 episodes we shot that these athletes have incredible relevance and access, but don't really know how to use it to access private deals. So they may have good wealth managers who manage their liquid assets in stocks and bonds, and good contract agents and marketing agents, but no one was advising them on where to deploy the 10 to 20% of their net worth that should go into private deals. So that was where the idea came from, and built it from kind of day one with first client, and now we have a couple hundred.
Anders,
one of my favorites is right here.
Yeah, of course. We love hockey players here. What drew you to this opportunity, Anders?
When I got introduced to these guys a couple years back, I think for me, at my point in my career and where I was, I hadn't dove into this side of investing before and had always been interested from school. And then we kind of just built a really nice, trustworthy relationship, and one where I could be an active investor, and while I'm doing this, learn a lot about it.
How have you seen that side of it evolve? I mean, years ago, every athlete essentially went broke after their playing deals because people got them to slap their name on a car dealership or a sports bar and they lost their money. And now it's athletes as investors. How have you seen that evolution take shape?
I think there's a big responsibility that we have. I mean, we're put in positions to make good decisions, and you want to really take advantage of these opportunities that we have. But it's really about just being smart. Doing the best you can, and being knowledgeable with all this stuff. Doing stuff blindly and puts you in a tough spot. So I think with these kind of relationships and being able to really just have the opportunity to learn what you're doing is really important.
Do the leagues talk about it now more than they used to?
Yeah, they did. I mean, I remember when I was a rookie, we were sent off and a big little camp, and the NHL walked us through on all the importances of saving your money, investing it correctly, and surrounding yourself with a team that has the same values that you have, and one that can look out for you. So yeah, there's a big importance on taking care of yourself.
Which gets us to Joe Burrow, Anders, and Zach Ertz, and these Blake Griffin, and an Iowa farmland. Why?
Well, first of all, just to be clear, we've done 21 investments with our colleagues and business partners like Anders. Only a couple of them are in the real estate space. One was a multifamily housing project in Florida. Farmland to me was interesting. First of all, we talked about it off the air. There are a lot of very well-known, successful people, Warren Buffett, Jeff Bezos, Bill Gates, who have invested in farmland. Number one, so it's never a bad idea to follow smart people. You don't have to be the smartest person in the room always to make good decisions. Second thing is, it's a really good inflation hedge. So we like it as a time and point in this industry and in this economy. We thought it was a smart place to put some money for someone who's sub 35 years old, has a really good net worth today, wants to maintain and grow that net worth, may not earn at the same level for the next 50 years. So think about it as a long-term investment opportunity. Also, you can do well and do good. The idea of being supportive to farmers. We're not managing the farm. We lease out the farm. This was the first of what will be probably a half dozen or so farms that will acquire a full kind of portfolio of farms. Won't all be in Iowa. But the thinking for us was this was a place that a person who's got a thoughtful approach to how to deploy their own personal capital should put some percentage of that into an investment opportunity like this that will generate a certain type of predictable return over a long period of time.
What type of investments do you look for? Do you tailor them specifically to guys like Anders?
No, because the same way Anders wouldn't ask me for a hockey tip, we're trying to find things that we think are the best investments, but that also match interests. So we've invested in a lot of consumer product companies, bunch of things in the auto space, some things in travel and hospitality. We invested in Virgin's cruise line. We invested in a company that provides aftermarket truck parts and accessories for pickup trucks and Jeeps. So we like them to have an interest and an affinity. So our goal is not to have each of the 200 athletes invest in every deal, but to have each of the athletes have a point of view in each of our deals.
And what type of investments interest you in particular, Anders? And this is something you talk about now amongst your fellow professional athletes?
Yeah, I mean, I like the ones sometimes that I see in my daily life, like we did the Real Truck one and Bombas, things that I've seen around and have used. Relate to things I've used before. You know, even looking into the alcohol space, you know, that kind of thing is really interesting to me, to see how they can grow, where they start. And sometimes how far they have to go to be successful, and you can kind of see trends throughout them. At least in that space, been familiar with a little bit, and it's pretty cool to see how that works.
I think there was a crossover coming between alcohol and the farmland. Is that right, Mark?
You tell me.
Coming project.
We look at things in all space. We've done a couple liquor deals.
A well-known alcohol brand was referenced in a piece about this project.
Oh, well, we invested in Old Smoky whiskey. That's what you're thinking of. Sorry. We think about things that are, you know, obviously categories where we know there's going to be growth. The businesses we look at, and by the way, you mentioned learning. We've done a ton with our athlete clients around teaching, but teaching, you know, peer-to-peer versus speaking down to them, which I think has happened a lot in the history of sports. And, you know, we select clients really carefully. We turn down athletes all the time. So we want ones who want to engage with what we're doing and become thoughtful, smart investors. And if they want to go off and do it on their own without us in other ways, they're obviously, of course, welcome to do that, and we would encourage it.
Love it.
So, but the categories that we focus on are businesses that we understand the product, we understand the supply chain, we understand the marketplace for exit, which is really important. So we're not investing in something that's going to take 10 years to get out of.
And something they relate to.
Unless it's farmland.
Beat the Red Wings for me, will you?
Appreciate
All right,
it.
that's the next game on the ice. Anders, good to see you. Mark, thanks for being
Thanks
here
for
as
having
well.
us.
Appreciate that. All right, coming up, our next guest tells us why housing could be the Cinderella story of 2023. Stay with us.
We're seeing some positive signs for the housing market. U.S. new home sales climbing for the third month in a row. New home sales increasing 2.3% in December to 616,000 units sold, and a good sign for buyers sidelined by higher rates. Mortgage rates continuing to fall, declining to 6.13%. And mortgage application payments are down nearly 3% in December. Our next guest has some big predictions for the housing market in 2023. We want to bring in Tim Rude, Citus AMC Head of Government and Industry Relations, joining us now as part of our real estate report brought to you by Intuit TurboTax. Tim, it's great to see you here. So it looks like things are trending in the right direction for housing. Those doom and gloom predictions, are they simply wrong?
Well, look, we already said the Cinderella story, so I'm already kind of dating myself. So I'll say it this way. everybody loves a turnaround story, right? The underdog. The epitaph was written on the housing market ad nauseum for the last 6 months, and you're starting to see signs that both the existing home market and the new home market are coming back. It's not a miraculous thing. It's not an immaculate thing. It clearly is dovetailing right with interest rates, which have fallen about 1% over the last 4 months after that, record high for this cycle in the plus 7% range come last fall. So a lot of people were on the sidelines, a lot of people looking over the fence, waiting for the opportunity to get into this market. And this drop in interest rates has really given them the opportunity.
I don't want to be the pessimist here, Tim, because I am an optimist when it comes to real estate. But if you're locked into a mortgage, high 2s, maybe low 3s, which most are, is a rate north of 6 going to get you off the sidelines? How low do you think they're going to get this year?
It's tough. Look, you're hitting right on the main point, which is you have this locked-in effect. So if you're a seller or a prospective seller, I think it's close to 90% have got a interest rate in the 3s. So if you're looking at the sticker shock of a 6% or so, there's both the financial and there's also a psychological barrier to actually doing that. What you do see is some of the higher end coastal areas where people are actually selling those expensive houses and then going into migrating to areas that are more affordable, lower cost homes and whatnot, and buying those properties with cash. You're seeing about 30% of purchases right now are done with cash, and that means that it's about 10% higher than it had been historically. Doesn't bode well for the first-time home buyers, though, who have to compete with those all-cash offers, with contingencies around financing and home inspections and whatnot. So it's good in one sense, but bad for the first-time home buyers.
Tim, what's your view just in terms of the hottest areas where you think we'll likely see the most activity? It seems like time and time again, people are talking about the Sun Belt area, also just more specifically that southeast region as well. Is that where you're expecting to see the most activity?
Yeah, look, the things that are driving, Shauna, the affordability are generally about 4 things. You've got the employment markets, you've got the climate, you've got they're looking at suburbs, they're looking at more space, green space, bigger space. And of course, they have to be affordable. So, I mean, those are the markets that tend to be, historically has been in the Southwest, but you're seeing a lot of action, particularly a lot of building in the Northeast and the Midwest where land is cheap. And again, these economies can afford those sort of opportunities for prospective buyers.
Home builder stocks have been popping a bit to start the year. Will that continue?
Boy, those guys took it hard last year. I mean, it was a brutal market for them. There's no doubt coming. I think you've had the confidence rate for home builders has been dropping for 12 months. It's pretty brutal. So they're coming back. Look, come the first of this year, you're starting to see home mortgage purchase applications go up. You're seeing new home sales purchases go up. All of those things are particularly positive, but there's so many things going on. The government's got its hand in a couple of places and probably needs to get it in a couple of other places. And I'll just hit you the high notes and you can tell me where you want to go. If you think about the new home market, which is important because it's 20% of GDP, you want to stave off a recession, of course, but also if you build more supply, you have a market-based solution for bringing down the cost of housing, apartments or single families. So as you do that, then ultimately that impacts the CPI, the inflation rate, because 30% of inflation or CPI has to do with shelter. So you need to get more supply out there. Unfortunately, the government has been focused on the demand side of the equation so heavy and so long that they're now about 90% of all originations are guaranteed by the federal government. And they've been doing that because first they wanted to focus on tax incentives for home purchases. Then they wanted to focus on subsidizing interest rates. Then they wanted to expand access to credit, which has all been great. But if you're not focused on the supply side, then all you're doing is creating more demand. And without more supply, those sort of subsidies end up ignoring the benefits to higher prices that ignore the benefits to the sellers. So there needs to be something done there. And also the government can step in and do things to change input costs, material costs, skilled labor availability and cost, land costs, and the big one has been regulatory compliance costs, which is almost $90,000 before you even drive a nail into a board or a brick into the ground. Those are the kinds of things that the government really needs to be focused on.
But are you concerned that that's a bit of fighting the Fed, putting more stimulus out there, kind of what got us into this mess?
Yeah, they've got some cognitive dissonance going on in the federal government right now, where you've got obviously Jerome Powell, who's trying to raise the cost of home ownership so that will ultimately back off demand. But at the same time, now you've got the federal government Biden just came out with a plan that says this is their blueprint for a Bill of Rights for renters. And the idea there is that, look, we're going to put rent controls in place. We're going to try to prevent evictions from happening and things like that. That those are working at cross purposes in terms of what the government is trying to do. One side is trying to make it more expensive to bring down inflation, and the other one is dealing with the reality. It says, my God, my constituents are having to pay 40, 50, 60% of their income for their house payments, their rent payments, and all of those things. So they're trying to suppress it through these things like potentially rent controls, which are ill-fated for anybody who's ever read an economics book. It's a terrible idea that is well-intentioned, but I could go on with some of the consequences in the event that you have the time.
Unfortunately, we are out of time, but it's been a great discussion. Tim Rood, we appreciate it. All right, Shauna, let's check out what's moving after hours.
All right, we've got a lot to take a look at here, Dave. We have Intel, KLA, Visa, Hasbro, and Salesforce. Kicking off with Intel, that stock off just about 8% here after hours. A weak report here from the company, missing on both the top and bottom lines. Their guidance coming in a bit light. We certainly are seeing that reflected in the after hours move here. The CFO of Intel saying that they did take steps to right-size the business in Q4. We know their cost-cutting efforts. They're looking to cut $3 billion in costs this year, up to $10 billion in 2025. Over the last 3 months, the stock has gotten a bit of a boost here, up just about 10.5%, nearly giving all of that back, though, in extended trading. Taking a look at KLA, that stock also under a bit of pressure, off just about 5% right now. The company's thinking as the outlook disappointed. This, of course, follows that drop in the chip demand. So Intel, KLA, those reports disappointing. We're seeing that also reflected in some of those competitors out there. NVIDIA stock under pressure, Qualcomm stock under pressure here after hours. So a couple of names to keep in mind ahead of tomorrow's opening bell. Taking a look at Hasbro, that stock off just about 9% of a huge headlines here. They announced their preliminary results, cutting 1,000 jobs, 15% of their workforce. President and COO here, Eric Nyman, will also be leaving the company. The prelim Q4 revenue number missed, EPS coming in a bit light. Holiday sales, quote, underperformed. Certainly we're seeing that reflected in that 9% drop. Taking a look at Visa, that stock up just about 1.5% here. The company beating on both the top and bottom lines. Payment volume up 7%. Visa also saying that effective February 1st, Brian McInerney will be taking over as CEO. Again, we're looking at gains here after hours. Rounding it out with Salesforce, that stock under a bit of pressure after popping here in intraday trading, but off just about 0.5%. A Wall Street Journal report now out saying that Elliott is preparing to nominate directors at Salesforce. They didn't name any specific names, but clearly a battle is heating up for some of those board seats. Now, the Journal reports followed the Bloomberg report that we got out earlier this afternoon saying that Salesforce is discussing appointing new board members. Some of those names that were being discussed: former Carnival CEO Arnold Donald, MasterCard CFO Sachin Mehra. Now, this is for Salesforce. Wall Street Journal now reporting that Elliott is preparing to nominate its own directors here for Salesforce. Again, the stock up barely in positive territory over the last 3 months, up just about 3%. Well, coming up, the trailer for season 4 of Succession is out, and you may see a very familiar face. We'll show it to you when we come back. HBO's award-winning show Succession dropping its trailer this morning, and a very, very familiar face making an appearance. Now, if you blinked, you might have missed him. So we're going to show you the trailer here, and here we go. All right, we're pausing it. We got to zoom in, circle it right there on the left-hand side of your screen, a bit blurry, but that is our very own Dave Briggs making that very quick appearance. Although this is brief, we know you're going to play a very pivotal role. A star is born. We have a celebrity here among us.
Yeah,
I feel honored to be sitting next to you.
You can get an autograph later.
Even more so than I.
You can get an autograph. You can get a selfie later. That may be as much as you see of me in season 4 of the Succession, but it was the thrill of a lifetime, quite frankly, getting to shoot these scenes as a news anchor for ATN. We are shooting the election. I can't say much more than that, but it is a big election season for Succession. I can't promise that you'll hear me, but I do know that you will in fact see me this season. Oh wait, did I make that?
We photoshopped you even into that. Yeah, you're right among all the stars there. Were you at all starstruck by any of the leads here?
Well,
I would have been.
Nicholas Braun, who I am peeking over his shoulder, he's my favorite character in the show. So I'm really happy that I was photoshopped right in over his shoulder.
You guys look like you're best friends there.
But Roman, I mean, this show is fantastic. I will say, I do think it is the best show on television. I think it is the best written, the best casted show. I don't know if you watch it.
Obviously, you're in it.
But it is tremendous. You will get a glimpse of me this season.
I do watch Succession, so I will be looking for you. We got to figure out what episodes you're on, but I, of course, will be having that eagle eye. Hopefully, it'll be a little bit bigger, though, on this
Lincoln, you may miss it. That'll do it for us today for Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage. There he is, baby! My starring moment. We'll see you tomorrow.